Good morning, students. Once again, welcome to auditing class. Students, in the last class, we have discussed on the primary objectives of auditing. Now, today on the secondary objective or subsidiary objectives of auditing. Here, the secondary objectives of auditing it includes first one, detection and prevention of errors. Second one, detection and prevention of frauds. Here, first one that is detection and prevention of errors. That means here how to detect and prevent the occurrence of errors in the books of accounts. So before going to uh, study on this aspect, first let me know what is error. Errors refer to unintentional misstatements in the records or books. Here, error may be defined as a mistake of negligence or misjudgment without an intention to defraud. Actually, the errors, the occurrence of error, it affect the financial statement. Audit aims at finding out all errors. Errors arise in accounts due to the negligence or carelessness of the bookkeepers in recording the transactions in the books of account or due to their negligence of the principles of accountancy. Now we'll study that is the what are the different types of errors. So broadly, errors are classified into two main categories: clerical or technical errors. Second one is errors of principles. Now, the first category, that is clerical or technical errors. It refers to all types of errors committed on account of clerical mistakes. Usually, such mistake is committed by the clerical staff of the client. And this error is again subclassified into four. One is errors of omission, second one errors of commission, third one compensating errors, and the next one is errors of duplication. Now, first one is that is errors of omission. This error arises when a transaction has been omitted to be recorded in the books of account either wholly or partially. That means here, when a transaction is omitted fully or partially from the books of account, such types of errors are known as errors of omission. Usually, it arises due to mistake of the clerical staff, and this error may be complete omission or an error of partial omission. Now, we'll see some examples relating to errors of omission. One may be if a credit purchase of goods is omitted to be entered in the purchaser's book, it is an error of complete omission. Next may be here omission of sales from the sales day book. So this is the one more example. Or we may take the example if furniture purchased on credit from a party, say Mr. X, is entered in the journal proper but is omitted to be posted to both the furniture account and X account, it is an error of complete omission. Now we'll see the next one, what is error of commission. It refers to errors committed in the process of posting from the subsidiary books to the ledger accounts, casting, carry forward, and balancing of ledger accounts. Here, when entries made in the books of original entry or ledger are incorrect wholly or partially, such error of that is commission. These errors may or may not affect trial balance, profit and loss account, and balance sheet. And these errors may be intentional or otherwise. Now we'll see some examples pertaining to errors of commission. Sorry, error of commission. First example may be a purchase invoice for rupees 1250. I repeat, 1250. The invoice mentioned price is 1250. Was entered in the purchase book as rupees 1520. So here we are observing the interchange between the digits 1250. Okay. The first and last digits are same here while writing 1520. Only the two digits are interchanged 25 and 52. So actually you have to write 1250 but wrongly entered as 1520. It may be due to eyesight, okay, or due to negligence or due to say mistake of the clerical staff. So error may occur. Second one may be goods of rupees 500 purchased from M and Company recorded as from N and Company. Here in the name of the supplier is mistake we are observing. In purchase day book, so this is another example for the error of commission. Similarly, wrong calculations, wrong carry forwards, wrong postings, wrong balancing, wrong totaling, wrong additions. These are the some more examples of the error of commission. So actually, it may be intentional or unintentional. Next, we'll see that is the yes third one. Third one, compensating errors. So what actually the compensating errors? Is also called by the name. There is the offsetting error. Where one error is compensated, offset by another error. That's why it is called compensating error. Here, when the effect of one error is counterbalanced or compensated by another error, such errors are known as compensating errors. I'll give you one example. Say X account is under totaled by rupees 100 and Y account is over totaled by rupees 100. So one is under totaled, one account is under totaled, and another account is over totaled. Amount is same 100. So mistake at one side is counterbalanced by the mistake of another side. So actually detection of such error is difficult, but by careful checking, so it can be detected. Now fourth one is there is error of duplication. So in the name itself you are observing. So duplication pertaining to the transaction is occurring. Such error arises when an entry in a book of original entry has been made twice and also been posted twice. That means so this error arises when the same transaction is recorded twice in the books of original entry and posted twice in the ledger. Say I will give one example. A credit sale of rupees 10,000 to Q to Mr. Q is entered in the sales book twice and posted twice in the ledger to their respective accounts. Here, both debit and credit for this transaction have been recorded twice in the journal and ledger, and therefore such error do not affect the agreement of trial balance. Now we'll go for the next category of error, that is error of principle. So what actually the error of principle? Okay. So we will study the error of principle. An error of principle arises when the generally accepted principles of accountancy are not observed or not followed while recording a transaction in the books of account. Okay. Here, this error arises when the generally accepted principles of accountancy are not observed. Now we'll see the examples pertaining to this error. One is here, that is capital expenditure recorded as revenue expenditure. Okay. So example may be wages paid to workers engaged in the installation of a machine debited to wages account instead of machinery account. Actually, it is a capital expenditure. Okay. But wrongly it is treated. Similarly, revenue expenditure recorded as a capital expenditure. Here, the examples may be repairs to building, debited to building account instead to repairs account. So here, generally accepted accounting principles are not followed. Similar examples may be posting wages paid to general expense account. So these errors do not affect the net profits of a business, but correct picture of the business account is not available. Okay. Now we'll come out with some more information in the next class.